This video is for anyone preparing to sit for the Utah Life Insurance Producer Exam, the Line Utah Codes as Series 17-01. Everything here is about Utah and only Utah, the state laws, the dollar figures, the deadlines, and the rules that make Utah different from what you are learning in your national study material. We are going to assume you are studying the general concepts somewhere else. What term insurance is, how whole life builds cash value, how an annuity pays out. Hold on to all of that. What we add here is the Utah layer, the part of the exam that trips people up precisely because it is specific to this state. By the end, you will know the numbers Utah expects you to have memorized cold, and you will know where the exam likes to set its traps. Let's get to work. Start with who is in charge, because the exam expects you to know the structure. Insurance in Utah is regulated by the Utah Insurance Department, led by the Insurance Commissioner. The Commissioner is the official who issues licenses, writes administrative rules, approves continuing education, investigates misconduct, and can suspend or revoke the license of a producer who breaks the rules. When a question refers to actions taken by the regulator, the actor it means is the Commissioner. The body of law the Commissioner enforces is Title 31A of the Utah Code, the Insurance Code. Nearly every Utah-specific answer on your exam traces back to a section of Title 31A or to an administrative rule built on top of it. You do not need to recite section numbers to pass, but you do need to recognize that Utah's rules are statutory. They carry the force of law, and an insurer or producer cannot simply waive them. Here is a useful way to think about it. Utah does not invent its insurance law from scratch. Like every state, it works within a national framework set by the National Association of Insurance Commissioners, a coordinating body of state regulators that publishes model laws. Utah then adopts those models with its own adjustments. That is exactly why this video exists. The places where Utah's number differs from the model are the places the exam earns its money. One more piece of structure. Utah does not write or grade your exam itself. The department contracts that out to an independent testing vendor called Prometric, which administers the test and reports your score to the department. We will come back to Prometric in detail at the end when we cover test day logistics. For now, just lock in the chain of authority. The Commissioner and the department make the rules, Title 31A is the law, and Prometric delivers the exam. With that frame in place, we can talk about how you actually get licensed. Studying for your insurance licensing exam? Check out the My Insurance Guide flashcards app, built specifically to help you pass your insurance licensing exam with confidence. Master over 1,000 expertly curated flashcards across every insurance line. Built-in spaced repetition brings back the tough terms right when you need them, and timed practice exams prepare you for the real thing. Click the link below and download today. Now, back to the video. To qualify for a Utah resident producer license, you must clear 4 basic gates. You must be at least 18 years old. You must be a Utah resident. You must be of good character and competency, which is the department's way of saying your background will be reviewed. And you must pass the required license examination. Memorize the age, 18. If an answer choice offers 21, be suspicious, because 18 is the number Utah uses. Because that character review is real, Utah requires fingerprinting for an initial resident license. After you pass your exam, your fingerprints are captured electronically at the Prometric Test Center using live scan technology and sent to both state and federal authorities for a criminal background check. 2 details the exam likes. First, fingerprinting is required only for an initial resident license. If you already hold a Utah resident license and you are simply adding a new line of authority, you are not fingerprinted again. Second, you cannot apply for the license before you pass the exam. The application comes after the passing score, completed right there at the test center kiosk. You submit that application electronically, either through CIRCON or through the National Insurance Producer Registry, the online system the industry calls NIPR. Utah no longer accepts paper applications. A paper application mailed to the department may simply be returned to you unprocessed. So the electronic route is not a convenience, it is the requirement. Here is a deadline worth circling. Your license application and fee must be submitted within 90 days of passing your exam. We will say that again, 90 days. Miss that window and your passing score expires, and you have to take the exam over again. On your exam, if you are asked how long a passing score stays good for, the answer is 90 days. Now, passing and getting licensed is not the same as being able to sell. To actually transact insurance, you need an appointment, that is the authorization from an insurer to represent it, or a designation with a licensed agency. A producer whose license is active but who is not appointed or designated still holds a valid license, but cannot conduct business until that appointment is in place. The exam likes to separate these two ideas, so keep them separate in your head. The license makes you eligible, the appointment lets you work. One specialty add-on matters for life producers. If you intend to sell variable life insurance or variable annuities, products whose values rise and fall with investments, Utah requires more than a life license. You must also hold a current FINRA qualification, that is the Financial Industry Regulatory Authority that oversees securities, and you must be registered with the Utah Securities Division. The logic is simple. A variable product is part insurance and part security, so it is regulated by both. Remember that pairing because the exam tests it. Let's recap the licensing numbers before we move on. You must be 18. Fingerprinting applies to an initial resident license only. You apply electronically through CIRCON or NIPR, never on paper. And you have 90 days after passing to submit your application before the score expires. With the license earned, the next question is how you keep it. A Utah individual producer license runs on a 2-year cycle, and Utah ties that cycle to something personal, your birth month. Your license expires on the last day of your birth month every 2 years. Because of that, the very first renewal period on a brand new license is not exactly 2 years. It can run anywhere from 24 to 35 months, stretching to land on your birth month, and after that, it settles into a clean 2-year rhythm. The takeaway for the exam is the system itself. Utah uses a birth month renewal every 2 years. To renew, you must complete your continuing education first, and these are numbers to memorize. Utah requires 24 hours of continuing education every 2-year period. We'll say that again, 24 hours. Of those 24, at least 12 must be completed in a classroom or classroom equivalent setting, meaning live instruction such as a webinar rather than pure self-study. 3 of the 24 hours must be ethics. And there is a cap you should know. No more than 12 of your hours may come from courses provided by insurers. The remaining hours can be in any line of insurance, and every course has to be approved by the Utah Insurance Department. So picture the 24 hours as a whole. 3 are ethics. At least 12 are classroom or classroom equivalent. No more than 12 come from insurer courses. Mix those numbers up, and the exam will catch you, so anchor the big one first. 24 hours, 3 of them ethics. What happens if a license lapses? Utah gives you a 1-year reinstatement window. If you reinstate within 1 year of the expiration date, you complete the required 24 hours of continuing education, you pay the reinstatement fee, and you are back. You do not have to retake the exam, and you do not have to be fingerprinted again. We'll repeat the key figure, 1 year. Cross that 1-year line, though, and the door closes. After 1 year, you are treated as a brand new applicant, which means passing the exam again and being fingerprinted again. On your exam, if you are asked whether a producer must retest after a lapse, the answer hinges on that 1-year mark. Inside 1 year, no retest. Past 1 year, start over. One more obligation that runs the whole time you are licensed. If your address, phone number, or business email changes, you must notify the commissioner within 30 days. That is 30 days, and you make the change yourself electronically. It is a small rule, but it is exactly the kind of specific number the exam likes to ask. Let's lock the section's figures. 24 continuing education hours every 2 years, 3 in ethics, at least 12 in a classroom setting, a 1-year reinstatement window, and a 30-day deadline to report a change of address. Those are the numbers that keep your license alive. Next, we turn from your license to your conduct. Every state forbids the same broad categories of producer misconduct, and Utah is no exception, but Utah has a few wrinkles the exam reaches for. Begin with the universal ones so the vocabulary is clear. Misrepresentation means making a false or misleading statement about a policy. Twisting means using misrepresentation to convince someone to drop one policy and buy another. Churning is the same harm using the same insurer's policies, replacing a customer's existing coverage to generate a new commission. And rebating means offering something of value not stated in the policy, a share of your commission, a gift, a special favor, to induce someone to buy. Utah prohibits all of these, and a producer who engages in them risks license suspension or revocation by the commissioner. Now, the Utah-specific wrinkle the department actively warns producers about, because it is both a real enforcement priority and fair game for the exam. Under Utah law, an insurance policy or annuity contract form may not be sold or offered to a Utah resident unless that form has been filed with the commissioner. Some producers have tried to get around this by driving a Utah resident across the state line to sign an application in a neighboring state for a product that was never filed in Utah. Here is the rule that defeats that scheme. Utah law applies to policies on persons residing in Utah when the policy is issued, regardless of where the application was physically signed. So, taking a client to another state to sign does not make an unfiled product legal. It is still a violation of Utah law. On your exam, if a scenario has a producer crossing a state line to sell a product not available in Utah, that producer is breaking the law. Full stop. There is a federal layer worth knowing, too, because Utah enforces it. Under federal law, a person convicted of a felony involving dishonesty or breach of trust may not work in the business of insurance without first obtaining written consent. In Utah's case, the written consent of the insurance commissioner. A criminal conviction involving fraud, misrepresentation, theft, or dishonesty can bar someone from even applying for a license for a period of time. The exam may frame this as a question about whether a past conviction ends an insurance career. The nuanced answer is that it can require written consent rather than being an automatic permanent bar. Finally, a conduct rule that connects to a topic we will cover shortly. Utah prohibits an insurer or producer from using the existence of the State Guarantee Association or its coverage to encourage someone to buy insurance. You may not tell a hesitant client, "Do not worry, the Guarantee Fund has you covered." That is an illegal sales inducement. Hold that thought, because the Guarantee Association itself is coming up. To recap the conduct rules, misrepresentation, twisting, churning, and rebating are all prohibited. A policy form must be filed in Utah before it is sold to a Utah resident, no matter where it is signed. A felony involving dishonesty requires the commissioner's written consent to work in insurance, and you may never use the Guarantee Association as a selling point. Now let's get into the contract provisions themselves. This is one of the most heavily tested areas because these are the numbers baked into every Utah life policy. We will go through them one at a time, and we will repeat the figures because these are the ones the exam swaps and shuffles. Start with the grace period. The grace period is the stretch of time after a premium due date during which the policy stays in full force even though the premium has not yet been paid. In Utah, every individual life policy must give a grace period of at least 31 days. We'll say that again, 31 days. If premiums are paid more often than monthly, the minimum is 4 weeks. During that grace period, the coverage continues. So here is a classic scenario. A premium is due on the 1st of the month, and the policyholder does not pay it. On the 20th of that same month, the insured dies. Is the death benefit payable? Yes. The policy was still inside its 31-day grace period, so it remained in full force, and the insurer pays the benefit, though it may subtract the overdue premium from the proceeds. On your exam, anchor the number at 31 days, and remember that the policy stays alive throughout. Next, the free look, which Utah calls the policy examination period. This is the window after you receive a policy in which you can return it for a full refund of premium, no questions asked. Utah sets that window at 10 days from delivery. We'll repeat it, 10 days. And here is the Utah wrinkle the exam loves. If the new policy is replacing another life insurance policy, the free look is extended to 30 days. So the pattern is 10 days normally, 30 days on a replacement. Notice how easy it would be to mix those up, which is exactly why the exam pairs them. If a question describes a brand new policy with no replacement, the answer is 10 days. If it describes a replacement, the answer is 30 days. Now, reinstatement, and be careful, because this is a different idea from the grace period and a different idea from the free look. Reinstatement is bringing a lapsed policy back to life after the grace period has already passed and the policy has terminated for non-payment. Utah lets a policyholder apply to reinstate an individual life policy within 3 years of the premium default. We'll say that again, 3 years. There is a Utah-specific exception. For a policy with a face amount under $5,000, the reinstatement window is 2 years instead of 3. To reinstate, the policyholder has to show evidence of insurability, meaning they prove they are still insurable, and they must pay all the back premiums with interest. Contrast that with the free look and the grace period, where no proof of health is ever required. On your exam, the trap is the 3-year window versus the under $5,000 2-year window. Keep both numbers ready. 2 provisions about contesting a claim come next, and they share the same magic number. The incontestability provision says that after a life policy has been in force for 2 years during the insured's lifetime, the insurer can no longer contest it for misstatements on the application. 2 years, and the policy becomes incontestable. The suicide provision uses the same 2-year period. If the insured dies by suicide within the first 2 years, the insurer does not pay the full death benefit, but instead refunds the premiums that were paid. After 2 years, suicide is treated like any other covered death, and the full benefit is paid. Both numbers are 2 years, which makes them easy to remember and easy for the exam to test together. One more contract rule that Utah words a little more broadly than some states. If the age of the insured is misstated on the application, the death benefit is adjusted to the amount the premium actually paid would have purchased at the correct age. Utah applies that same adjustment to a misstatement of gender, not just age. So the misstatement provision does not void the policy, and it does not simply refund premiums. It adjusts the benefit up or down to match what the money should have bought. That is the answer the exam wants. A quick note on group life, since the figure differs in a way worth knowing. A group life policy must provide a grace period of at least 31 days as well, the same as individual life. Consistent numbers, but the exam may still ask, so 31 days covers both. Let's recap the must-memorize numbers from this section, because this is where points are won and lost. The grace period is 31 days. The free look is 10 days, or 30 days on a replacement. Reinstatement runs 3 years, or 2 years, for a face amount under $5,000. Incontestability and suicide both run 2 years. And a misstatement of age or gender adjusts the benefit rather than voiding the policy. Get those straight, and you have conquered the hardest cluster on the Utah portion. Speaking of replacement, that deserves its own section. Replacement gets special treatment under Utah law because it is where consumers are most likely to be harmed. Replacement means a transaction in which a new life insurance policy or annuity is bought, and, as part of the deal, an existing policy is surrendered, lapsed, or otherwise reduced in value. The danger is obvious. A customer can be talked into giving up coverage they have held for years, restarting contestability and incontestability clocks, and possibly paying higher premiums for someone now older. Utah regulates this through its replacement rule, and the duties fall on you, the producer. When you take an application and you know a replacement is likely involved, You must find out whether the applicant already has life insurance or an annuity, and you must give the applicant the required notice about what replacing a policy can cost them. The purpose, in plain terms, is to make sure the customer is making an informed choice rather than an impulsive one driven by a sales pitch. Once you understand that purpose, the specific duties follow naturally. Disclose, document, and slow the transaction down enough for the customer to think. Remember the connection we drew earlier, because the exam rewards it. When a new life policy replaces an existing one, the free look stretches from 10 days to 30 days. That extended examination period exists precisely so a replacing customer has more time to compare the new policy against the old one and back out if the trade is a bad one. So replacement does not just add paperwork, it changes a number you already learned. On your exam, if a question gives you a replacement and asks about the right to return, reach for 30 days, not 10. Here is a short scenario to make it concrete. A producer persuades a client to surrender a whole life policy that has been in force for 5 years and buy a new one. The producer skips the replacement notice and never asks about existing coverage. Has the producer done anything wrong? Yes, Utah's replacement rule required the producer to identify the existing policy and deliver the replacement disclosure. And skipping that is a violation, the kind of conduct the commissioner can discipline. Let's recap. Replacement is surrendering or reducing an existing policy to fund a new one. The producer must ask about existing coverage and deliver the required notice. And the free look on the new policy extends to 30 days. Keep that 30-day figure linked in your mind to replacement. Closely related to replacement is the world of annuities, where Utah adds its own training and conduct standards. Annuities carry roughly the same weight on the Utah Life exam as the policy provisions we just covered, so this section earns close attention. An annuity, recall from your national study, is a contract that converts money into a stream of income, often for retirement. Because retirees are a vulnerable audience and annuities can be complex and costly, Utah holds producers to a heightened standard when recommending them. That standard is the best interest obligation. Under Utah's suitability rule, when you recommend an annuity, you must act in the best interest of the consumer under the circumstances known at the time, without placing your own financial interest or the insurer's ahead of the customer's. Utah breaks the best interest duty into 4 obligations, and the exam may name them. There is a care obligation. You must know the customer's financial situation, insurance needs, and objectives, understand the options available, and have a reasonable basis to believe the annuity you recommend actually fits. There is a disclosure obligation. You must tell the customer about the product's features, its costs, any surrender period and surrender charge, and how you are paid. There is a conflict of interest obligation. You must identify and avoid or manage conflicts. And there is a documentation obligation. You must record the basis for your recommendation. Know the customer, understand the product, manage conflicts, document the reasoning. That is the best interest standard in 4 moves. To make sure producers can actually do this, Utah requires annuity-specific training before you sell a single annuity. You must complete a one-time 4-hour annuity best interest training course approved by the department before you solicit, sell, or negotiate any annuity in Utah. We'll say it again, a one-time 4-hour course completed before your first annuity sale. On top of that general training, you must also satisfy the insurer's own product-specific training for each annuity product you sell. So there are 2 layers: the 4-hour state best interest course once, and the carrier's product training for each product. On your exam, if you are asked what a producer must do before selling an annuity in Utah, the anchor answer is that one-time 4-hour best interest training plus product-specific training from the insurer. Long-term care insurance carries its own training mandate, and because life producers often encounter long-term care riders, the exam may include it here. Before you sell long-term care insurance in Utah, you must complete an initial 3-hour long-term care training course. After that, you must complete a 3-hour ongoing long-term care course in every renewal period to keep selling those products. So the long-term care pattern is 3 hours up front and 3 hours each renewal. And notice it differs from the annuity rule, where the main course is a single 4-hour course done once. The exam likes to swap these, so keep them apart. Annuities, 4 hours one time. Long-term care, 3 hours initially and 3 hours every renewal. Let's recap this section's figures because they are prime exam targets. The annuity best interest training is a one-time 4-hour course before your first sale, plus product-specific training from the insurer. Long-term care training is 3 hours initially and 3 hours each renewal. And the best interest standard rests on 4 duties: care, disclosure, conflict of interest, and documentation. Now to a topic with some of the largest dollar figures on the exam. Every state has a safety net for the moment an insurance company fails, and in Utah, it is the Utah Life and Health Insurance Guarantee Association. Its job is to step in when a member insurer becomes insolvent, that is, financially unable to pay its claims, and to continue coverage and pay claims up to limits set by Utah law. The money comes from assessments on the other insurers doing business in the state, not from taxpayers. Every insurer licensed to write life, health, or annuity business in Utah must belong to the association as a condition of doing business here. Now the dollar limits, and this is where Utah quietly departs from the national model, so pay close attention to the figures. For a life insurance death benefit, the association covers up to $500,000 per insured life. We'll say that again, $500,000 in death benefit. For a life policy's net cash surrender value, the coverage is up to $200,000 per insured life. For annuity benefits, the limit is $250,000 in present value per contract owner. And for health insurance claims, the cap is $500,000 per insured life. Here is why those numbers matter beyond simple memorization. The national model many states adopt sets the death benefit limit at $300,000 and the cash value limit at $100,000. Utah is more generous, $500,000 for the death benefit and $200,000 for cash value. So if you studied the national figures, set them aside here. Utah's life numbers are higher. The annuity limit of $250,000 does match the common national figure, which is a small mercy. On your exam, if you see $300,000 offered as the Utah death benefit limit, be suspicious, because the Utah answer is $500,000. One worked example because the exam likes the trap built into per-owner limits. Suppose someone owns 3 separate annuities, each worth $250,000, all with the same insurer, and that insurer fails. How much does the Guarantee Association protect? Not $750,000. The limit is $250,000 per contract owner per insolvent company, totaled across all of that owner's annuities, so the protection is $250,000, period. The excess becomes a claim against the failed company's remaining assets. The lesson the exam wants: the cap is per owner, not per contract. And recall the conduct rule from earlier, because it lives right here. It is illegal for a producer or insurer to use the existence of the Guarantee Association to sell a policy. You cannot reassure a nervous buyer by pointing to the safety net. The association exists to protect consumers after a failure, not to serve as a marketing tool before one. Let's recap the caps, which are pure memorization points. $500,000 for a life-death benefit, $200,000 for life cash surrender value, $250,000 for annuity present value per owner, and $500,000 for health claims. Remember, Utah runs higher than the national model on the life figures. With the substance covered, let's get you ready for test day itself. Knowing the material is most of the battle, but knowing the shape of the exam removes the surprises. So here is exactly what to expect. The Utah Life Producer Exam is Series 17-01, and it is delivered by Prometric. The exam contains 100 questions, and you are given a 2-hour time limit. We'll say that again, 100 questions in 2 hours. To pass, you need a score of 70%. The questions are split into content areas with set weights, and knowing them tells you where to focus. Life insurance basics is the single largest area at 20% of the exam. Policy provisions, options, and riders make up 18%, and annuities another 18%, which is why we spent so much time on both. Insurance regulation and general insurance are 10% each. Life insurance policies another 10%. Federal tax considerations 9%, and qualified plans the smallest slice at 5%. Notice that provisions and annuities together are more than a third of the test, so the numbers you drilled earlier are not trivia. They are the core. A few mechanical points that catch people off guard. Every question is multiple choice with 4 options, and some appear in an all of the following except format, so read each stem carefully to see whether it is asking what is true or what is false. The exam may also include a handful of experimental questions that do not count toward your score and are not labeled, so do not waste energy trying to spot them. Just answer everything as well as you can. No calculators are allowed in the room. Plan to arrive at least 30 minutes before your appointment, and bring a valid, unexpired, government-issued photo identification whose name matches your registration exactly. You have a choice in how you sit the exam. You can test at a Prometric test center, or you can take it from an approved remote location through Prometric's online proctoring system, as long as your computer meets the requirements. Your fingerprinting for an initial resident license, however, has to be done in person at a Prometric center in Utah, so the remote option covers the exam, not the background check. You get your result the moment you finish, the score appears on screen, and you receive a printed report. And Prometric reports your passing score to the department within 48 hours. Then remember the deadline we covered at the start. You have 90 days from passing to submit your license application and fee, or the score expires and you test again. Let's recap the logistics. Series 1701, 100 questions, 2 hours, 70% to pass. The biggest content area is life insurance basics at 20%, with provisions and annuities at 18% each. No calculators, arrive 30 minutes early with matching photo identification, and apply within 90 days of passing. That is everything you need to walk in calm. You have now covered the entire Utah-specific layer, so let's do one final sweep of the numbers you must walk in knowing. The grace period is 31 days. The free look is 10 days and 30 days on a replacement. Policy reinstatement runs 3 years or 2 years for a face amount under $5,000. Incontestability and suicide both run 2 years. Continuing education is 24 hours every 2 years, with 3 in ethics and at least 12 in a classroom. Your license renews on your birth month, and a lapsed license can be reinstated within 1 year without retesting. Annuity training is a one-time 4-hour best interest course. Long-term care training is 3 hours up front and 3 hours each renewal. The Guarantee Association covers $500,000 in death benefit, $200,000 in cash value, and $250,000 in annuity value per owner. And the exam is Series 1701, 100 questions, 2 hours, 70% to pass, applied for within 90 days. If those figures feel like a lot right now, that is normal, and the fix is repetition. Come back to this video, say the numbers out loud, and let the contrasts with the national material do the work. The Utah answer is usually the one that is a little different, and now you know which way it differs. You are more ready than you feel. Go earn that license. If this helped you study, please like the video and subscribe so the next person preparing for the Utah exam can find it too. We are rooting for you.